G'day Melanie, this is a great question. So my fixed rate ends in February and not sure whether I want to fix it again for another year or go back to variable. I'm going to run you through some of the key considerations. Now this is general advice. Make sure that you do your own research and get some advice before you take action on this video. But hopefully I can give you some information that may help you inform your decision and how you may consider moving forwards. Now, what we've got to understand is that there are two basically ways that you can structure your mortgage. There is a variable rate, meaning that you have a floating note, a floating rate that as interest rates shift and change over time, your interest rate will shift and change as well. And there is a fixed rate whereby you can negotiate with your bank in order to get a certain interest rate for a period of time, typically between 1 and 5 years, guaranteeing that you will only pay that interest rate over time. Now, there are a couple of considerations. Firstly, when you have a variable mortgage, you have the ability to make unlimited extra repayments on that mortgage. Typically speaking, for most fixed rate mortgages, there is a cap on the amount of additional repayments that you can make. For most of those banks, it's $10,000 per year extra that you can make on additional repayments to your mortgage. So the first consideration that I look at between going variable and fixed is what is my surplus capacity and what is my intention for paying down my mortgage over that particular period of time. So firstly, if I believe that I have surplus above and beyond the cap on the fixed rate, then that is my first port of call, because the idea is that interest rate is affecting the overall balance of your mortgage. Depending on how much you can pay that down, that is my first consideration. The second consideration is that banks are in the business of making money, and largely they are going to set their fixed rate based on an indicator of what they believe rates are going to do over that period of time. So typically speaking, if you see the variable rate and say over a 2, 3, 4, 5 year period of time, the bank is forecasting that the interest rates or the fixed rate they're offering is lower, it is usually because they believe that interest rates are going to drop over that period of time, and it essentially allows them to lock in future business, providing essentially peace of mind to you that your rate is not going to go any higher. So if the fixed rate is typically lower than the variable rate, the banks think that rates are going to decline over that period of time, or if the fixed rate is higher, then usually it's going to mean that they believe rates are going to go up. The third consideration is in regards to your personal affordability. So if you believe that you cannot afford for interest rates to go any further or go up any further, and that is going to have to force you to go into financial hardship or sell that particular property, then a fixed rate is basically an insurance policy for you. It allows you to have the peace of mind and certainty to know that at least over that period of time, you are going to have a guaranteed interest rate and a repayment that you are going to commit to over that period of time. Now, it's not to say that rates aren't going to go up at the end and therefore you're going to find yourself in the same position, but at least it provides you with peace of mind and certainty over that period of time. We've seen many people at the top of an interest rate cycle lock in their rate and then rates subsequently decline, but because of the fact that they couldn't afford for rates to go up any further, they'd be happy to lock in that premium even though they've lost out over the long term. Now, generally speaking, over long periods of time, people who are on a variable rate typically pay lower than those who are on a fixed rate, and that's largely because that interest rates usually work their way out over time. Fixed rates are a mechanism for banks to make more money in exchange for providing that peace of mind. So it's really about understanding those three factors. Your intentions for aggressively paying down that loan and your capacity to do so. 2, your perspective on what you believe interest rates are going to do moving forwards and how that compares in terms of the variable and the fixed rate in the market at the moment. And thirdly, your household affordability and whether you can afford for interest rates to go up and whether you would prefer the peace of mind to know that you're not going to be subject to that over that period of time. Hope that makes sense. Make sure you consult a good mortgage broker who can do the shopping around for you and see if there's any other cheaper rates out there. And if there's any way we can help, feel free to let us know and drop your comments below.